All right, so we're back. And today, we're diving deep into some of Warren Buffett's dividend stock picks.
Yeah, interesting.
Yeah, we've got research and data that spans decades.
Okay.
And, it's not just about the numbers, though.
Right.
We're going to uncover the stories behind some of these companies.
Mm-hmm.
Why Buffett chose them, how they've performed over time.
Makes sense.
Names, like Coca-Cola, American Express, Apple. We're going to see them through a whole new lens today.
I like it.
So while dividends are definitely part of it,
Yeah.
Buffett really focuses on companies with what he calls economic moats.
Economic moats. Yeah, these are companies that are really difficult to compete with.
Right. So give me an example of that. Like, what would an economic moat be?
So think of like a castle, right?
Okay.
A castle that's really hard to attack because of its defenses.
Sure.
And those defenses are the moat.
Okay.
And so in business, a company's moat might be a strong brand, unique technology, a loyal customer base, something like that. Yeah.
So they've got something that other companies can't really replicate easily.
Exactly. It's hard to copy.
Okay, so it's not just about chasing the highest dividend yield.
Right.
It's more about finding companies that are going to generate earnings reliably over time.
Yes, exactly.
Okay, that makes sense.
And those consistent earnings can support a growing stream of dividends, which is what makes them really valuable to long-term investors.
Right, like Buffett, exactly.
Like Buffett, yep.
All right, let's get into some specifics then.
Right.
Okay, this one kind of blew my mind.
Okay.
Buffett's company, Berkshire Hathaway, makes over $700 million a year.
Wow.
Just from Coca-Cola dividends.
Wow, just from the dividends.
Just from the dividends.
Oh, that's incredible.
I know, it's crazy.
There's a lot of Coke.
That's a lot of Coke, right? But even crazier, I think, is the stock price growth.
Okay.
Back when Buffett started buying in 1988, a share of Coke was about $2.50, and that's adjusted for splits.
Okay.
Now it's over $60. So tell me about this dividend king status. What does that even mean?
Yeah, so Coca-Cola is a classic example of what we call a dividend king, which is basically a company that's increased its dividend payout for over 60 years straight.
60 years.
60 years in a row.
That's amazing.
To be able to do that, you need consistent profitability.
Right.
And a commitment to shareholders, which Coke clearly has.
Makes sense.
Think about it. No matter what's happening in the economy, people are still drinking Coca-Cola.
True.
They've got global brand recognition, incredible distribution network.
Yeah.
And it gives them staying power.
They're not going anywhere.
Not going anywhere.
Okay, so it's not just about the product itself.
Correct.
It's the business model, the brand.
The whole package.
It's everything.
It's everything.
Okay, so let's move on to American Express.
Okay, yeah.
What I find fascinating about this one is that Buffett invested back in the 1960s.
Wow, so early on.
Yeah, long before it was the giant that it is today.
That's impressive.
Talk about long-term vision.
Long-term vision, yeah. And that's one of the key things with Buffett's approach, right?
Yeah.
He's incredibly patient.
Yeah.
He's willing to bet on these companies for the long haul.
Yeah.
With American Express, he saw the potential of their brand.
Okay.
And the fact that they were focusing on a higher income customer base.
Okay. Yeah.
Who tend to spend more and default less.
Interesting.
And it was a smart bet.
Yeah.
Because shares that were around like $8 to $10 in the early 90s are now over $200.
Oh, wow.
So he saw something there.
He definitely did.
Way back when.
Okay, so let's shift gears a little bit.
Sure.
To two more really well-known companies, Procter & Gamble.
Yep.
And Johnson & Johnson.
Yeah.
These are both in Buffett's portfolio, and both are dividend kings, right?
That's right.
So they've both increased their dividends for over 60 years straight.
That's right. Consistently growing.
That's wild.
Yeah, Procter & Gamble, Buffett actually acquired that through Gillette.
Oh.
So it's a consumer goods giant, right?
Makes sense.
Johnson & Johnson is a leader in healthcare.
Yeah.
But what they have in common is this focus on essential products.
Okay.
Things that people use every day, regardless of the economy.
Exactly.
So that gives them stability, consistent dividend growth.
So they're the steady performers.
Exactly. The steady eddies.
You can rely on.
You can always count on them.
Through good times and bad.
That's right.
So do all of Buffett's dividend picks have that same, essential product quality?
Not necessarily.
Okay.
Let's take Apple, for example.
Okay.
It wasn't always considered a dividend stock.
Right.
But under Tim Cook, they've really become like a modern dividend giant.
Interesting.
And Buffett recognized this potential. Started buying back in 2016.
Okay.
And Since then, the stock price has increased more than 5 times.
Wow. Okay.
It's been a pretty good run.
That's a huge increase. I mean, we're talking about a tech giant here, not toothpaste and razors.
Right, exactly. So why is Apple such a powerhouse when it comes to dividends?
Yeah, what's the story there?
Well, it all comes down to cash flow.
Oh,
Apple generates massive amounts of free cash flow,
okay.
meaning after they've covered their expenses, their investments, they have all this money left over.
Yeah.
And that allows them to not only fund future growth,
Right.
but also return capital to shareholders through dividends and share buybacks.
Hold on. Explain share buybacks to me.
Yeah, so when a company buys back its own stock, it's basically reducing the number of shares outstanding,
Okay.
which can increase the value of the remaining shares.
Makes sense.
It's another way to give back to the shareholders,
Okay.
and it can make the dividends even more impactful.
Okay, so it's like a way to kind of boost the value of those shares
Exactly.
and give investors a cash return.
It's 2 birds, 1 stone.
Okay, that's pretty smart.
Yeah.
Let's finish up this part of our deep dive
Sure.
with 2 names from the financial world, Wells Fargo and Bank of America.
Yeah, 2 big banks.
Now, Buffett famously exited Wells Fargo back in 2022.
You did, yeah, after a long history with them.
Yeah, what happened there?
Yeah, so Wells Fargo, unfortunately, had a number of scandals and controversies,
Oh, right.
and it really impacted Buffett's confidence in their leadership and their long-term prospects.
So even the Oracle of Omaha makes mistakes.
Well, even the best investors get things wrong sometimes.
True.
It just shows you that things can change,
Right.
and you have to be willing to adjust your strategy.
That's a good reminder.
Yeah.
And it's a stark contrast to his approach with Bank of America.
Right.
I mean, he started investing in them during the 2008 financial crisis.
Yeah, when everyone else was running for the hills.
Exactly. He saw an opportunity there.
He did, yeah, to buy a great company at a great price.
So Berkshire Hathaway has benefited a lot from that bank's recovery and dividend growth.
Absolutely. They've been consistently increasing their dividend.
Okay, so even in a really volatile industry like finance,
Yeah,
there are opportunities to find reliable dividend payers.
absolutely. You just got to know where to look.
Okay, so we've covered a lot here. We've seen how Buffett approaches dividend stocks. He's not just chasing that yield.
Okay.
He's looking for those economic moats
Long-term value.
that can stand the test of time.
Exactly.
We've also seen how different those moats can be
Oh, yeah.
from, Coca-Cola's brand power
Yeah.
to Apple's crazy cash flow machine.
It's pretty incredible.
I mean, it's really fascinating to see how he puts it all together.
It is. There's a lot to learn from him.
But there's still so much more to unpack.
Oh, yeah, definitely.
So stay tuned, because we're going to continue our deep dive into Warren Buffett's dividend stock picks.
All right. Looking forward to it.
It's fascinating to see how Buffett combines those long-term investments with this whole idea of compounding.
Oh, yeah. It's like he's playing a totally different game than most investors.
Yeah, it really is like he's not interested in quick flips or chasing the hottest trends.
Not at all. His strategy is all about letting those investments grow gradually over time.
Yeah.
Like that snowball effect.
Right.
It just gets bigger as it rolls down the hill.
Exactly. So as your investments generate dividends, you reinvest those dividends to buy more shares.
Right. And then those shares generate even more dividends.
And it just keeps building on itself.
Exactly. It's a really powerful cycle.
I mean, it makes me think about those early investments in companies like Coca-Cola, American Express.
Yeah.
Imagine the patience it took to hold on to those stocks for decades.
Decades. Yeah, that's the key.
And let that compounding work its magic.
It's like a superpower almost.
Yeah, it really is. But I think it's a superpower that's available to any investor.
I agree. Absolutely.
It just takes discipline, a long-term perspective.
That long-term vision is so important.
Okay, so let's break this down for our listener.
Okay, sounds good.
What are some practical lessons that we can take away from Buffett's dividend strategy?
Well, one of the biggest takeaways is that time in the market is more important than trying to time the market.
Right.
Buffett doesn't try to predict those short-term ups and downs.
No, he doesn't.
He focuses on finding quality companies and holding on to them for the long haul.
It's a good point. It's so easy to get caught up in all the daily noise of the market.
It really is.
But his approach is a good reminder that patience and discipline are key.
Absolutely. Slow and steady wins the race.
Another important lesson is to focus on quality over quantity.
Right. Exactly. Don't just chase the highest dividend yield out there.
Yeah.
Look for companies with strong fundamentals, like those economic moats we talked about.
Yeah.
Consistent earnings growth,
Right.
a history of returning capital to shareholders. Those are the things you should be looking for.
It makes me think about those dividend kings?
Yeah.
Coca-Cola, Procter & Gamble, Johnson & Johnson.
Yep, the classics.
They might not have the most exciting growth stories,
No.
but they're the steady performers
They're the ones you can count on.
through thick and thin.
Exactly, like a rock.
And that's important, too.
Oh, yeah, absolutely.
Now, it's important to remember that dividends are just one piece of the puzzle. Capital appreciation, that increase in the value of the stock itself, is also really important.
It's a huge part of the total return.
Right. We can't just fixate on that dividend yield.
Exactly. A company that's growing its earnings and reinvest in wisely can create a lot of value for shareholders.
Even if the dividend isn't the highest.
Exactly. It's about finding that balance, right, between income and growth.
That's a good point.
Look at Apple, for example.
Yeah.
Their dividend yield might not be the highest out there,
Sure.
but their incredible growth
Yeah.
and those massive share buybacks
Right.
have generated tremendous returns.
So we're starting to see the bigger picture here.
It's all coming together.
Buffett's approach isn't just about picking dividend stocks.
Right.
It's about understanding how those dividends fit into a long-term investment strategy.
Exactly. It's about the big picture.
So it's about identifying those companies that can generate consistent earnings,
Right.
return capital to shareholders,
Yes.
and grow their value over time.
That's the trifecta right there.
You know, I have to ask, what about those companies that Buffett has sold?
Interesting.
Like Procter & Gamble
Yeah.
and Wells Fargo.
Right.
Does that mean that they're no longer good investments?
Well, that's a really good question.
Yeah.
And, even Buffett adjusts his portfolio based on changing circumstances.
Right.
He might sell a stock because he needs to diversify,
Okay.
or because market conditions have shifted,
Right.
or even because he's lost confidence in the company's leadership.
So it's not always a reflection on the company itself.
Not necessarily. It's more about his overall strategy and outlook.
So we shouldn't automatically assume that a company is a bad investment just because Buffett sold it.
No, not at all. You always have to do your own research.
Absolutely.
Assess the company's fundamentals
Right.
and decide if it aligns with your own investment goals.
And your risk tolerance.
Exactly.
So we can learn from his moves.
Definitely. But we have to make our own decisions.
Right, exactly. And speaking of decisions,
Yeah.
let's wrap up this part of our deep dive with a challenge for our listeners.
I like it.
Knowing what you know now about Buffett's approach,
Mm-hmm.
what companies do you think have the potential to become future dividend giants?
Ooh, that's a great question.
What companies are out there with those
Mhm.
strong economic moats, consistent earnings growth?
Commitment to shareholder value.
Exactly. Which companies do you think can deliver both income and growth for decades to come?
It's an exciting challenge.
It is.
We're encouraging you to think like Warren Buffett.
Yeah.
Analyze the businesses around you
Yeah.
and see if you can spot those next generation dividend champions.
It's all about looking beyond the headlines, right?
Absolutely.
Understanding what makes a business truly enduring.
That's what it's all about.
Yeah, it really is like we're on a treasure hunt for those hidden gems.
Exactly. And just like any good treasure hunt, it takes careful observation, some research,
Yeah.
a bit of intuition. It's
Right.
not just about following the crowd. You got to develop your own independent judgment.
You know, one thing that really stands out to me about Buffett's approach is his discipline.
Yeah, he's incredibly disciplined.
It's so easy to get caught up in the excitement of it all, you know?
Absolutely.
But he stays so focused on those long-term goals.
He's always thinking long term.
He's famous for saying that his favorite holding period is forever.
That's right, forever.
Oh, it says a lot.
It really does. It speaks volumes about his commitment to finding companies he believes in
Yeah.
and letting those investments just compound and grow over time.
It's not about timing the market perfectly or chasing those quick profits.
Nope.
It's about building a portfolio that you're comfortable holding for years, even decades.
That's the key long-term vision.
Exactly.
Finding those companies that align with your investment philosophy.
Right.
And then just having the patience to let them work for you.
Okay, so as we wrap up our deep dive into Warren Buffett's dividend stock picks,
Yeah.
let's recap some of those key lessons for our listeners.
Okay, sounds good.
First and foremost, time is your greatest ally.
Absolutely.
Don't get caught up in that short-term noise of the market.
Tune it out.
Focus on the long game and let the power of compounding do its thing.
It's a beautiful thing.
It really is.
Second, prioritize quality over quantity. Look for those companies with the strong economic moats,
Yeah.
the consistent earnings growth, the solid track record of returning capital to shareholders.
Those are the hallmarks.
Those are the signs.
And third, Be patient.
Yes, patience is key.
Be disciplined.
Absolutely.
Develop a clear strategy.
Stick to your plan.
And stick to it.
Don't get swayed by the hype or the FOMO.
Exactly. And finally, never stop learning.
Oh, that's so important.
The world of investing is always changing.
It's constantly evolving.
So stay curious, keep reading, and be open to new ideas and perspectives.
Absolutely. There's always something new to learn.
By following these principles, you'll be well on your way to building a portfolio that can weather any storm.
That's right. A portfolio that can stand the test of time.
And ultimately help you achieve your financial goals.
That's the ultimate goal.
Well said. We hope you've enjoyed this deep dive into the world of Warren Buffett's dividend stock picks.
It's been a pleasure.
Remember, investing is a journey.
Is that a sprint?
Not a destination.
It's a marathon.
Take your time, do your research, and most importantly, enjoy the ride.
Enjoy the process.